Okay. It's my second go around on this, so hopefully this works better. All right, so here we're going to talk about the accounting cycle, which basically takes you from analyzing economic events and determining whether or not they affect the accounting equation and several other steps, and the goal is to create these financial statements for external users, and then you have some cleanup work to do after that. So that's called the accounting cycle. And so what you're doing is capturing these economic events for a period of time. And so accounting records are important in a company's existence and reason to be. These accounting records establish accountability for assets and transactions. They keep track of routine business activities. And of course you do that through creating the accounting records from the business activities. The accounting records obtain or have in them detailed information about a particular transaction. Users are able to evaluate the efficiency and performance within a company, internal users as well. And these accounting records maintain evidence of a company's business activities. Now, they start out talking about the ledger. The ledger holds all your accounts for a company in them, or in it. And so you'll have such accounts as the cash account that we saw, accounts payable, capital stock, and other types of accounts. Accounts are simply individual records showing increases and decreases in amounts in those accounts, and the entire group of accounts is kept together in an accounting record called a ledger. Usually you have a general ledger, and then you have various sub-ledgers on top of that with more detailed information. Now, the representation of an account for our purposes is reflected in what we call a T account. And so the elements of a T account are the title of the account, such as cash, and then you have the debit side, which just means left side, and then you have the right side, known as the credit side. Understand that the left side, the debit side, does not mean an increase. The credit side does not mean a decrease in an account. Whether something is an increase or decrease depends on the type of account you have. So increases are recorded on one side of the T account depending on the type of account, and then decreases are recorded on the other side. And so, for example, we have here the cash account. Now, if you recall, in our accounting equation, the the Yeah, the assets are on the left side of our accounting equation. And so what that means is that for cash, which is an asset, an increase in cash, an asset, is reported on the debit or left side. Any decreases in cash, reductions, are reported on the right or credit side. And note that over a period of time, here a month, the decrease, or excuse me, the net balance down there at the bottom on January 31st is a debit balance. And so note here that assets are going to have as their normal balance a debit balance. Liabilities are going to have as their normal balance, since they're on the right side of the accounting equation, a credit balance. And then owner's equity is kind of a special deal where you have different accounts, revenues, expenses, retained earnings, and dividends. So, you know, it kind of depends which account you're talking about. Some things decrease owner's equity, some things increase. So we'll talk about that separately. But overall, owner's equity has a credit balance. So an increase in owner's equity would be a credit to owner's equity. But we'll look at the details here in a few minutes. All right, so this kind of proves my point. You increase an asset by debiting it, you decrease it by crediting it, just the reverse for liabilities. You debit for a decrease, you credit for an increase. And then overall, owner's equity is increased by crediting it, but there, you know, again, there are 4 accounts you have to deal with, so it kind of depends on the account to whether or not you debit or credit a particular account to increase or decrease it. So we'll look at that here in a few minutes, like I said. Again, the normal balance of an asset is a debit balance. Normal balance of a liability and the overall owner's equity account is a credit balance. Note here we have this thing called double entry accounting, which means that in every transaction that we record, there are equal dollar amounts of debits and credits. It doesn't mean that both sides of the equation may not be affected. It may just be one side, but regardless, after recording a transaction, your debits equal your credits, or excuse me, yeah, your debits equal your credits. And the left side and the right side still equal. So best way to look at this is look at some transactions. We've already kind of done this. Remember, we had an $80,000 investment for 8,000 shares at $10 per share. And again, they're kind of misleading because what you're seeing here is the effect of this transaction in the ledger accounts involved. But before you even do this, I mean, the process is this. You analyze a transaction to see if it has an effect on the accounting equation. You journalize the transaction in the general journal usually. Sometimes it'll be a special journal. This general journal holds all transactions in date order, in the order that they occur. And then the reason they do that is because it's one source for almost all transactions. And then after you journalize, you post this transaction to the proper ledger accounts. And so that's really what's happening here is the posting. They're not yet talking about journalizing, but just realize the journalizing happens before the posting. So this transaction, it's going to be posted to the cash account with a debit, increasing cash $80,000, and to an owner's equity account called capital stock, increase it by crediting $80,000. Okay, so we'll move here at a pretty good pace because this should start to be somewhat second nature, hopefully. On January 21, Overnight purchased land for $52,000, so we reduce the cash account by $52,000. We create another ledger account called land and debit, increasing the balance in land to $52,000. Overnight purchased a garage for $36,000 by paying $6,000 in cash and issuing a note payable for the remaining $30,000. So we create a ledger account called building, debit it, increasing building account for $36,000, and then we reduce cash by $6,000, credit, and then we credit a liability account, increasing, create a liability account and increase the notes payable account by $30,000 credit. So notice our debits and our credits for this transaction equal. January 23rd, we purchased tools and equipment for $13,800 on account. And so we create a ledger account called tools and equipment. We create another and debit it. And we create another ledger account called accounts payable and credit it. Still in balance. January 24th, we sold part of the tools to Ace Towing for $1,800, a price equal to its overnight's cost. Ace agrees to pay overnight on account in the future. So they decrease equipment by crediting it $1,800, but we create another asset ledger account called accounts receivable and debit it. And understand, when you're doing these journal entries, you debit first and then credit second. Okay, so actually you would debit accounts receivable first and then you would credit tools and equipment. So here is a typical journal entry. This is the first entry that they would have made for the contribution of cash for capital stock of $80,000. Now understand that this is a representation of what it would look like on paper. Of course, you realize most everything these days is computerized, and so you can buy financial accounting software that basically, once you do the journal entry, it posts these journal entries to the ledger accounts. And so it's all done simultaneously. But even with the computer software systems, you have a separate general journal you can look at. If you want more detail, you can go to, in this case, the cash ledger account or the capital stock ledger account. Again, posting is simply updating ledger accounts for the effects of the transactions recorded in the journal. So analyze first. If there's an effect on the accounting equation, you journalize in the general journal usually, unless it's a special type of transaction. And then from there, you're going to post in the particular ledger accounts that are affected by the transaction. And again, notice in the journal entry, you have your date to the left. You debit first, cash in this instance, and then you credit, in this case, capital stock, and then you have your debit and credit balance over here. And of course, this is your general ledger account, this general journal account, and below it shows your general ledger account for cash, shows this same transaction. Now here in the general ledger account, it keeps a running balance. You're not going to have that in your T account, but because it's just too complicated. Same for capital stock. And one thing you want to make sure you do when you make these journal entries, you want to explain in as simple terms as possible what the transaction was about. Again, the general journal is the go-to place for the original entry, and so like auditors, independent auditors who come in and want to see details on an entry, this is where they go, the general journal, because it's the document of original entry for transactions. And so you need enough explanation to give someone not familiar with the transaction enough information to understand what the transaction was all about. And of course, here we have the land purchase, which increases land by 52, but reduces cash. And so at the end of that transaction, this is what your general ledger cash account looks like. There's a balance of $28,000. And so the ledger keeps a running balance, whereas with your T accounts, you won't. So it's kind of a modified ledger account. So T accounts simply are versions of the ledger accounts that only show the debit and credit columns, not the running total. What is net income in its simplest form? It's revenues minus expenses. Net income is not an asset. It's an increase in owner's equity from profits of the business. Income earned, either an asset is increased or a liability is decreased. Net income always results in the increase of owner's equity. But usually you're going to have revenues, which is an owner's equity account, less expenses, which is an owner's equity account. Revenues increase owner's equity, expenses decrease owner's equity. Two other accounts in owner's equity, capital stock, retained earnings, and then you also have, I said 4, but I guess there's actually 5. You also have dividends. Now, capital stock usually, not always, but usually is an increase which means it's a credit. Retained earnings is the difference between net income minus expenses. Well, really, retained earnings, that's net income. But retained earnings is the net income for the total period of time that the company's been in existence. So if they've been in existence for more than 1 year, your net income's not going to be the same as retained earnings, because retained earnings has multiple years in it of earnings. It's retained earnings is the earnings from multiple periods retained in the company and not paid out in dividends to the shareholders. Here we have an income statement. If you recall, like I said, revenues minus expenses equals net income. Of course, they have income before income taxes and then your income tax liability here. So this is a little more sophisticated presentation and quite proper. Notice again at the top you have your heading, identifies the company, the financial statement, and the period for which it's for. And note that it was year, so what we call calendar year end financial statement. Which brings me to the point, you have to have a stopping off point when you're preparing these financial statements, such as December 31st. And so we have this time period principle, which simply is a way to provide users of financial statements with timely information. Net income is measured for relatively short accounting periods of equal length. At some point, you have to stop and find out what the score is. Most companies, for external purposes, do this once a year. For internal purposes, they may do it as much as every month. Certainly, they would want to do it at least quarterly to find out where they are. Revenue is defined as the price for goods sold and or services rendered during a given accounting period. Again, revenue increases owner's equity. Expenses are the cost of goods and services used up in the process of earning revenue, and so expenses decrease owner's equity. Your normal balance for a revenue account is a credit balance because it increases owner's equity. Your normal balance for an expense account is a debit balance because it decreases owner's equity. Note here that we do not account for revenues and expenses using a cash method like you do with your checkbook. We use, and this is in accordance with generally accepted accounting principles, GAAP, we use what we call the accrual method of accounting, which simply states that we earn revenues and report them in the period in which we provide a good and or service. And we recognize an expense in the period, and expense includes liabilities, obviously, something you're going to pay for the future. But if you've utilized an expense, you have to recognize it in the period in which it's used. And so this idea of the matching principle for revenues says that revenues should be recognized at the time goods are sold and services or services are rendered. And of course, the matching principle says that you've got to match your expenses in the period in which they are used up as well. That could be a totally different year than when the expense is actually paid. You could use up an expense in this year. In other words, for instance, you use electricity in your business and you get a bill at the end of the month or the end of the year, and you're not going to pay it till the next year. You still have to recognize that expense in this year because that's when you used up that electricity. And so that's the idea here. You might receive or pay cash in one year. Let's say you receive cash as a prepayment from a customer, but you haven't provided a good or service. And as a prepayment in 15, and then when you provide a good or service, you're going to report that as revenues in that next year. Now, sometimes you prepay in one year, but you use it up. And so you would simply create an asset called prepaid rent in 2015, and you would recognize rent expense as you used it up. And in this case, their example, that would be next year. You might have a situation where cash is received or paid in the next period, but you have to recognize the revenue or expense in the current period. And so that revenue example would be where you provide a good or service in 2015, but you sell it on credit. You're not going to get paid till next year. You still have to recognize the revenue in 2015. And of course, your expense example is where you use electricity in 2015. In December, let's say, you get a bill at the end of December, you're not going to pay that till 2016. You still have to recognize the expense in 2015 because that's when you used it up. All right, so this goes back to my point that revenues increase owner's equity. Notice that owner's equity has as its normal balance a credit balance, and so does revenues. Expenses decrease owner's equity, and so it has as its normal balance a debit balance. Even though you have an increase in the expense account, decrease owner's equity. Dividends decrease owner's equity. And so, and again, this is a situation where when you pay a dividend, it decreases owner's equity, but it shows as an increase, meaning a debit. And then, of course, capital stock, the normal balance for receiving capital stock is a credit, which is an increase. So they want to look at some revenue and expense transactions for the month of February. We'll do this fairly quick because by this time you should have some familiarity with the process of analyzing and so forth. All right, so we pay Daily Tribune $360 cash for newspaper advertising to be run during February. We do that on February 1st. So we debit advertising expense and we credit or decrease our cash by $360. Now, again, all you're seeing is the effect on the ledger accounts. What you're not seeing is the fact that before they do this, they're going to journalize in the general journal by debiting advertising expense for $360 and crediting cash for $360 and noting what the transaction was about. On February 2nd, we purchased radio advertising from KRAM to be aired in February. The cost was $470, payable within 30 days. So we got another advertising expense. We debit in our journal entry $470 advertising expense and $470 accounts payable. And of course, again, we post to the various accounts as well. And so that's what you're seeing. Here's the effect of the posting. Moving on. February 4th, we purchased various supplies for $1,400 payable within 30 days. The supplies are expected to be used over the next 3 to 4 months. That's kind of an irrelevant fact at this point, although it may become relevant when you use up the supplies. And so we increase an account by debiting shop supplies. We have to create that account since it doesn't exist till now. We debit that account to increase it, and then we credit accounts payable for the $1,400. Overnight collected $4,980 for repairs made on vehicles of airport shuttle service. So we debit cash for $4,980 and we credit repair service revenue, which increases owner's equity, right? On the 28th, we overnight billed Harbor Cab Company $5,400 for maintenance and repair services provided in February, with payment to be received by March 10. Since we provided the repair services in February, we've got to recognize the income in February, not when we receive cash. So it's on account. We book it and debit accounts receivable for $5,400 and credit repair service revenue for $5,400. Overnight paid employees' wages earned in February of $4,900. So we're going to debit wage expense for $4,900 and we're going to credit cash, and that reduces cash by $4,900. And overnight recorded $1,600 utility bill for February. The entire amount is due March 15. So since we used it up in February, we've got to record this as a utility expense, debit $1,600, and we credit accounts payable for $1,600. Overnight declares and pays a dividend of 40 cents per share on the 8,000 shares of capital stock, totaling $3,200. So you debit $3,200 dividends and you credit $3,200 cash. After you analyze, journalize, and post, you're not going to do this every time. Usually you do it once a month at the end of the month after you've journalized and posted all your transactions for the month. You'll run what's called a trial balance. And a trial balance is simply all of your accounts, and the end result is all the debit balance accounts should equal all the credit balance accounts. Now, what does this not do? You know, assuming that all debit accounts and all credit accounts equal each other, meaning the bottom line number is equal both sides, what does that not mean? Well, it doesn't mean that all your entries for that month were correct. The amounts weren't correct necessarily, nor does it mean that you put them in the right accounts. So, but at least this gives you an idea that you're on the right track. All your debits and credits equaled each other. Note that again, a lot of this is bookkeeping, right? And so while some of that may be done by the more junior accountants, what senior accountants do is they spend much of their time focusing on the analytical aspects rather than the bookkeeping aspects. But the bookkeeping aspects are still important